I'm William Branch, your Texas local lender. How are you today? We're talking about what is a mortgage, how do I get one, and what are the steps? First, what is a mortgage? A mortgage is a security instrument between you and a lender that allows you to borrow money against a secured asset, which would be your home, that in default, the lender is going to be able to take that home back from you if you don't pay. That would be considered a foreclosure or a short sale. That's a negative piece that can happen if you do not pay, so just be on the lookout. It can really ruin your credit. It's one thing that we advise our clients not to do. We want to make sure that when we set everything up that we're going over your monthly payments, looking at your budget, looking at how much do you have out of pocket when we're setting everything up. So what is a mortgage and what are the terms? First, once we start everything, we're going to actually gather information from you. That's considered an application. So typically most of the time, most lenders are going to have a link that you're going to be a secured link that you'll go online and enter in all your information. A lender is going to be looking for, they're going to ask you for your name, your date of birth, your social security card, where you've lived for the last 2 years, your employment. They're looking at your assets. Make sure that on your bank statements that you don't have any large deposits. These are things that could potentially harm you in the process. So make sure you're very upfront with your lender. You don't have any funny money or cash that you're putting in the bank. So those are things just kind of to look for in that piece. Then the lender's going to gather that information. They're going to call you back. They're going to go over, make sure everything that you inputted on the application is going to be correct. And then at that point, they're going to dive into, they're first going to take a look at your credit. What is your credit score? They're looking at, have you missed any payments in the last 12 to 24 months? Are there any disputes on your credit? So, people think, oh, that's not right, or I've had a late payment, or there's a collection, let's just go dispute it, that'll help my credit score. Well, you can't just dispute things on your credit report just because. Can it improve your credit in the short run? Yes, but when it goes time to get a mortgage, these are things that could potentially harm you. So looking at your credit score, that's going to help the lender determine the type of loan program and what program is going to be best for them to use to help you get to the finish line once you're under contract. So we've gone through the credit piece. The next part, there's really the most important part that's going to determine your debt to income, is going to figure out how do you get paid. Are you a salaried employee? Are you hourly? Is your hourly wages, or does it vary? Do you work 40 hours a week, or is it 1 week you might work 32 hours, 1 week you might work 40, and those pay stubs that if you're saying that you work 40 hours, underwriter is going to calculate your hourly wage times 40 hours a week times 52 weeks, and that's going to calculate. So whenever they see that, hey, this may be off, the underwriter's going to question, why is his income not adding up to what his year-to-date is supposed to be? So at that point, we may have variable income at that point. Or something may have happened that you were out of work or something for a short time. It can be easily solved, but these are things that can come up as you're going through that process. So let's make sure that if anything's happened that you do talk to your lender about that thing. Second, you may be self-employed. Extra documentation is going to go into that. We're going to be looking for some set of tax returns. Are you a Schedule C? Are you a sole proprietorship? Are you a partnership? Or do you have an S-Corp corporation? So these are all important that as a lender, you provide all of your documentation to them up front. Otherwise, you're gonna get the sense that the lender just keeps asking for documentation over and over because you didn't provide that information up front. A lender will find this information typically on your Schedule E. It'll list out if you own any other businesses or a part of a business or have any ownership in a business. One question you might ask is like, hey, William, I don't have 25% ownership, or I don't have full ownership. I only have about 10% ownership in a business. Well, technically, you're not self-employed. So we would just need to get what's called a K-1 from that business partnership, or do our due diligence to verify that you don't have more than 25%. 25% or more ownership is going to validate that you are technically self-employed when we would actually need business tax returns. Whenever we're going through somebody that's self-employed, a lender's also going to require what's called a tax transcript. So believe it or not, there actually is some fraud out there that people do file fraudulent tax returns on somebody's behalf. And if we pull up a set of transcripts, we find sometimes that CPAs either forget, or depending on the time of year when they file, if they were mailed in, that the tax returns, they may take 3, 6, sometimes even 9 months. The IRS is super backed up right now. With COVID, they're still trying to catch up. But if you do mail in your tax returns, it does take, just keep in mind, it does take a lengthy amount of time to get those actual tax transcripts. That is one thing that can affect your interest rate. You could have to go what's called to a direct lender, meaning that we have to sell to Fannie Mae or Freddie Mac. And at that point, that could affect your interest rate by as much as a half to 3/4%, or even affect what we call as pricing, that you may have to pay a discount point to keep your rate. The different types of options that you're going to be looking at is typically, in most cases, we're looking at a 30-year option for most of our clients. But there are terms, let's say you want to, hey, William, I don't want to pay as much interest. So there are options that we can look at: a 25-year loan, a 15-year loan, 20-year, 10-year, all the way down to a 7-year loan. And that's obviously going to make your payment go up, but you're going to pay less interest. So everybody has their own threshold on how much they want to pay. And typically, in most cases, we do find a lot that we're looking at 30-year options for most of our clients. But note that there are options, and we'll talk about this later in other videos about how can I save money and interest on a mortgage. Talking about the different types of programs that we have, typically, you're looking at a conventional. There are USDA options of 0% down. You have FHA, it's for typically your lower credit score or higher debt to income clients. Or let's say if you've had a bankruptcy or a foreclosure or short sale, the length of time to be able to purchase is a lot sooner than it would be a conventional loan. We work with a lot of veterans. You're looking at on a typical VA loan, there's 0% down. We love our veteran community and serving our veterans. There's nothing better than helping a veteran purchase a new home with 0% down. And believe it or not, there's actually down payment assistance programs on top of these 3 programs that we can utilize that can help you if you don't have the 3.5% or 5% or 3% first down payment plus your closing costs. We can help you that in the form of grants, or there's terms of repayments that after 3 years, the money that you took out in a grant is actually considered forgivable. So those are options that we help people purchase on those programs. I won't get into too much detail, but there's different levels of assistance. You have 3, 4, and 5% assistance, and at each level, the interest rate will change. So make sure when you're talking to your lender that you ask about those programs to see if you qualify. Income is one of the main factors on those programs that allows you to qualify. So just make sure that you're working with a lender that knows what they're doing, because if you get into that program and then all of a sudden they don't do their homework and look at how much income you actually make, that you could be over the limit. So there are some tips and tricks that lenders can help you with on those programs, though, that if you are, we can take a borrower off or whatnot to make sure that we're still inside that parameter that meets them. But just work with a local expert and make sure you know what they're doing on that point. And then lastly, you're going to have your jumbo loans. The current conforming loan limit right now is going to be $647,200, and anything over that loan amount is what we call a jumbo loan. Typically on those loans, you're looking at 10, 15, most of the time 20% down. You're going to have extra what's called reserves. Reserves is take your monthly payment. They typically like 6 to 12 months in reserves, and that's how much extra you'd have to have of cash reserves towards your monthly payment. So we can use as far as any bank accounts or retirement income or 401ks as reserves. So just talk to your lender about those reserves and make sure that they set everything up properly on your behalf. Getting into kind of the documentation piece, it's really important that you provide your lender, as we talked about, all of your documentation. You're typically going to need a current driver's license that's going to be valid. You're going to need your social security card. Most lenders, if you don't have a social security card, they have what's called a social security authorization form that you can fill out that they can still validate your social and validate it up against your W-2. We'll need typically in most cases 1 to 2 years worth of W-2s. If you're self-employed, we're going to need 1 to 2 years worth of tax returns. If you've been self-employed for 5 years or more, typically a lender can just get away with 1 year's return. We're going to need 2 months worth of bank statements, 30 days worth of pay stubs if you are a salary or hourly employee. And then just make sure that you know on those pay stubs that if you do get a pay stub, that taxes and insurance are taken out, because if they're not taken out, all of your Social Security and FICA wages, a lender is going to look at that and they're going to say, hey, this borrower is actually self-employed because the lender doesn't take taxes out. So that can be a hindrance. That can be a problem that can come up in your mortgage, that you gave all the lender everything, or you just got pre-qualified. You went on to one of these online sites, they gave you a pre-qualification, they didn't look at your income up front, we're now under contract, and then we find out once we start going through all the paperwork that, hey, we can't do this mortgage. He just started his job 6 or 12 months ago, and we don't have tax returns to validate this guy's income. So those are things that can happen. They've happened to me before. Seen that if you don't gather all the documentation up front, don't take somebody's word, it can cause a huge problem in your mortgage process. All in all, getting a mortgage, the first thing that I can tell you is to get pre-qualified, work with a local lender, work with a local expert, trust your realtor. Thank you so much for tuning in to the Texas Local Lender channel. If you haven't liked and subscribed to our channel, please like and subscribe below. We will see you next time.